And now we are on to bonds and bond valuation. Bonds and bond valuation. So the first question is, what is a bond? A bond is an interest-only loan. What does that mean? An interest-only loan just makes interest payments over the whole life of the loan, and then the last interest and all the principal gets paid back at the end. So the loans that you're familiar with, like car loans and house loans, are called amortized loans, and each payment represents both principal and interest. But that's not the case here. It's just interest right up until the last day of the bond's life. So let's do a little vocabulary here. The borrower is also called the bond issuer. The borrower is also called the bond issuer. Who do they sell the bonds to? Well, the people that are buying the bonds are loaning money to the company or the government, and so they are the lenders. We also call them the bond buyers, but more often the bond holders. You hear a lot of discussion about bond holders when we have bankruptcies. So the borrower, which is the bond issuer, pays interest periodically throughout the life of the bond. Sometimes it's once every 6 months, sometimes it's once every year. And then the borrower pays all that remaining interest, so in other words, the last interest payment and all of the principal at the end of the bond's life. Does this sound too complex yet? No, it's pretty simple stuff. So let's do a little bond vocabulary. Those periodic interest payments we call coupons. And you may say, wait a minute, coupons are what my mom clips out of the newspaper to save money on whatever. Coupon is actually a French word. I think it means a little piece of paper cut out of a bigger piece of paper. Because back when bonds first came out, you had the bond at the top, and then across the bottom you had all these coupons. And in order to get your money, what you would do is clip a coupon and take it to your broker or to the company itself, and they would pay you the money in exchange for the coupon. In fact, people who were living off trust funds we referred to as coupon clippers, because that's how they supported themselves, was simply by cutting these coupons off bonds that maybe their parents had bought for them. Okay, now moving forward in time, do we still do this kind of clipping thing? There's a very small percentage of bonds today that have physical coupons. Most are electronic. And we still, though, refer to them as coupons, even though they're not made out of little pieces of paper. So a coupon is just the periodic interest rate or interest payment made on the bonds. And then we have face or par value. You could talk about the face value of a bond, you could talk about the par value of a bond. Those mean identically the same thing. And unless I tell you otherwise, you are to assume that the face or par value of a bond is $1,000. Unless I tell you otherwise, the face or par value of the bond is $1,000. And when is that $1,000 paid? It's paid at the end of the bond's life. That face or par value represents the principal. And then we have the coupon rate. The coupon rate is merely the percentage multiplied by the face value that gives us the annual amount of coupon paid. Now you have to be careful to realize that this is the annual amount of coupon paid, because we're going to have some bonds that pay more than one coupon per year. And so if they're paying 2 coupons per year, what we're going to do is take the coupon rate times the face value, divide by 2. Now what about maturity? Maturity is the date on which that face value will be paid. It's the date on which the face value will be paid. And after that last interest payment is made on that same day, and then the face value is paid, the bond is paid off. The bond stops existing. It's kind of like when you pay off your mortgage. Have you ever seen these people that pay off their mortgage and then set a fire to the mortgage and have a big party? Right? People don't do that anymore. People don't pay off their mortgage anymore, do they? Yeah. Okay. So I grew up around farmers, risk-averse farmers, and so the idea was pay off your debt as soon as you possibly can. And at that time, you got your thing paid off. It's a sign of joy to burn your mortgage. Okay. Now let's talk about price. People get price and face value confused. Price is what you would have to pay if you went out to buy this bond today. It is the market price of the bond. Price is what you would have to pay if you went out to buy the bond today. It's the market price of the bond. And just like the market price of stock, it's going to fluctuate with what's going on in the market. By the way, interest rates were on their way up, and then we had this recent incident with where Russia invades Ukraine. And anytime things start happening freaky like that, people lose faith in the Fed being able to raise interest rates, which is why interest rates were going up. And so interest rates actually went back down. And we're going to see that when interest rates go down, bond prices go up. Okay, so there's some volatility there, and we have yield to maturity. And yield to maturity is the required return on the bond. It is inextricably linked to the price. And so the face value gets often confused for price, but the face value stays the same over the life of the bond. The price may change. The coupon rate usually stays the same over the life of the bond, but the yield to maturity changes. Those last two things are determined by the market, and they're determined mathematically, and I'll show you how that works. Are there any questions yet? Okay. So what's a bond worth? Well, something I say quite a bit is that the price or value of anything is the present value of its expected future cash flows discounted at a risk appropriate to those cash flows. So what are the cash flows we get from bonds? Well, we get those coupons periodically, and then at the end we also get the face value. So those are the two cash flows that we need to put together. And the cool thing is that those coupons are basically an annuity. We know how to find the present value of an annuity. And the face value is basically just like a future value, a lump sum sitting out there in the future. And so all I've got to do is find the present value of that annuity plus the present value of the lump sum, and that's going to give me the price of the bond. That's it. We're going to find the present value. So here we go with our bond pricing example. First of all, I say the bond has a face value of $1,000. Did I even have to tell you that? No, why not, Ms. Flowers? Because I just told you that. You're right. It's you're supposed to default assume it's $1,000, and overwhelmingly most bonds are. It has a coupon rate of 6%. Knowing those two pieces of information, can you tell me how much this bond pays per year in coupon payments? 60. Very good. Now, when I take 6% of 1,000, here's the easy way to remember it. If I've got 6% of 1,000, basically, in order to find out the annual amount of coupon, all I have to do is add a 0 to the coupon rate. And that's because 0.06 times 1,000, if we do the divide by 100 stuff, it comes out to we're basically just multiplying by 10. So that's the shortcut in your mind when you're doing this. You look at that and you say coupon rate of 6%. If it's got a face value of 1,000, you know it's going to be paying 60 a year in coupon. They tell us it's got 10 years to maturity. The interest is paid annually. So now we know that each of those individual coupons is actually going to be 60 because there's only one annual coupon payment and the bond is paying $60 per year in coupons. The market requires a 6% return on this bond. This 6% is the yield to maturity. Remember, the yield to maturity is the rate required by the market. And that yield to maturity is going to change daily based on what's going on in the market. Okay, so let's get out our calculators if you haven't already. And we are going to use our time value of money keys in order to compute this. And so what I want to do is say second clear TVM, so second FV. And that clears out everything that was in here previously. Otherwise, you might get in trouble. Let's start with face value of 1,000. What do you think I should do with that? Ooh, we're trying to calculate its present value. And by the way, when am I going to collect that 1,000?
In the future.
In the future, right? So it's future value. Question?
No, I was just,
Oh.
sorry.
That was just some knowledge burbling out. There we go. Okay, now let's see, 60, that coupon. What do you think I should do with it? Payment, very good. It's a repeating payment. And then we've got 10 years to maturity, that is N. And then, let's see, we have 6 for the yield to maturity. What should we do with that? Yeah, it's I over Y. It's the interest rate. And then we're going to compute the present value. Now, a couple of weird things going on here. Number one, notice that present value is negative. Why is that? Take it.
You're paying that out.
Yeah, it's cash flow in the opposite direction. If I had to go buy this bond today, I'd be paying out that 1,000, and then I would be collecting the 60s all along, and then at the end I would also collect the 1,000. So here's what you need to get from that. Because coupons and the face value flow in the same direction, they have to have the same sign. And because price flows in the opposite direction, it has to have the opposite sign. If we had put the coupon and the face value in there as negatives, our present value would have came out positive, and it would still be cool. Now, let me tell you something that's not cool. That is, if you have the same sign on the price and the coupon, and a different sign on future value, nothing will save you. Nothing will save you. So just think about it. The money's coming in from the coupons, the money's coming in from the face value, the money's going out when you buy the bonds. If you cannot remember which two match, just write it on your note sheet, right? But you could think through it easily enough. Okay. Oh, okay, so let's also talk about why this thing's 1,000. Do you think bonds always sell for their face value? No. In fact, it would be a rare thing for a bond to actually sell at its face value. And when it does this, we refer to it as a par bond because it is selling at its par value. Earlier, I said we can say face value and par value interchangeably. You can't do that with the term par bond. If you said face bond, people would laugh at you because that's just the kind of cruel people in finance we have, right? Okay, par bond, selling for its face value. Now the bigger question is, why in the world is this thing selling for its face value? And the answer is this. The coupons are exactly enough to meet the investor's required return. The reason this thing is selling at par is because the coupon is exactly enough to meet the investor's required return. What do I mean? Coupon rate is 6%. Yield to maturity, 6%. If the coupon rate is equal to the yield to maturity, then you're going to have a par bond. Why is that? If the yield to maturity was higher than the coupon rate, the coupons would not be enough to satisfy the investor's return. They would demand a capital gain on the bond, so they would only be willing to pay a discount for it. So then they could get the coupons and the capital gain. But what if the coupons were larger than the yield to maturity? Then people would be willing to accept a capital loss to hold the bonds because the coupons are more than enough to satisfy their desired return. But in this one, it's that very special, very rare occasion when those two things, coupon rate and yield to maturity, are the same, and so there doesn't have to be any capital gain or loss on the bond to make it all work out. Any questions? Yes?
Just slide the calculator down.
Oh, yeah.
Thank you.
You didn't bring your PowerPoints with you to class? Why? Because
Something like this.
didn't want to print them out. Okay, so here's my recommendation on PowerPoints. Print one per page, or if you write very small, you can do what Ms. Flowers has done, which is the 3 per page with the lines. And then write your notes on the slide where I say it, right? And then when you go back, you'll have both of them to refer to. And you won't have to depend on me to move the calculator in order to be able to see what's going on. Questions? Okay. The next example looks very, very, very similar. It says a bond with a face value of 1,000 has a coupon rate of 6%, 10 years to maturity, interest paid annually. The market requires a 7% return on this bond. What is the only thing that's changed here? Yeah, the yield and maturity. So really, all that stuff is still on my calculator. All I have to do is go in here and say 7i per y, compute present value, and I have my new answer. Did you guys get this answer? Okay, so let's talk about this. This is lower than 1,000. If the bond is selling for less than face value, we call it a discount bond. A discount bond. If it's selling for less than face value, we call it a discount bond. Now, raise your hand if you like a discount. Yeah, we all like discounts, right? And so you might say, wow, this bond's on sale. I need to buy that bond. Here's the problem. The reason this bond is on sale is because the coupons are not enough to satisfy investors' required return. That means that the risk of this company is high enough. People are requiring 7% instead of 6%, and so they're only willing to buy this bond at a discount. And what does that mean? It means not only are they going to get the coupons over the life of the bond, but they're also going to get a capital gain, going from $929.76 up to, by the way, what's the bond worth on its last second of life? Well, $1,000, right? And so that's your capital gain. Questions? Okay. Looks the same except for what's changed. Yeah, the yield and maturity. So all I got to do is go back to my calculator and say 5i per y, compute present value. Now we're selling for $1,077.22. We are actually selling for more than the face value of the bond. Why is that? Because the coupons are more than enough to satisfy investors' required return. And so in fact, they're willing to accept a capital loss on this bond because after that capital loss, they will be getting the 5% that they are demanding. This is called a premium bond. So many of you probably you like certain kinds of cars that are too expensive for you to afford, or you like a certain variety of leather handbag that's considered upscale. Those things are called premium products. Is a premium bond better than a par bond or a discount bond? It sounds like it, but it's not. It's not like you can carry your premium bond around with you. Check out my premium bond. That's not what we're doing here. The premium bond is just like the par bond and the discount bond. It is appropriately or efficiently, it's priced based on the cash flows and the risk. That's it. And so you're not getting a bargain when you buy a discount bond. You're not overpaying when you buy a premium bond. You shouldn't brag to your friends that you've been buying premium bonds, because first of all, your friends probably don't even know what that is. Maybe it would work to brag to them. Who knows? My point to you is this: they're all fairly priced based on the cash flows and the risk. Any questions? Oh yeah, go ahead.
I have a question. I don't know if this is a stupid one, but so whenever we're looking at premium par or discount bonds, are we only looking at the coupon and the yield and maturity? That's the only two factors?
Oh, that's not a stupid question. That's an amazing question. She's asking because you're soft spoken, I'm going to repeat the question. She's saying, we just have to look at the coupon rate and the yield to maturity to determine whether it's discount, premium, or par? And she's absolutely right. Because if the yield to maturity is greater than the coupon rate, it's going to be a discount bond. If the yield to maturity is equal to the coupon rate, it's going to be a par bond. And if the coupon rate is is greater than the yield to maturity, then it's going to be a premium bond. And so you are absolutely right. That's really what we look at. Good question. Other questions? Yes, Ms. Herb. Oh, she's been reading ahead. Yes. Okay. Now, first of all, the answer to what I just talked about is no. It won't change, right? So we'll still end up premium, par, discount. But there are going to be some changes as a result of changing the time period on the payments. Excellent questions. Other questions? Okay. So let's look at the next example. A bond with a face value of 1,000. I didn't have to tell you that. Coupon rate of 6%, 10 years to maturity. The interest is paid semi-annually. How many coupons per year is semi-annual? 2. Very good. So that means the coupons are paid every how many months? 6. Very good. The market requires a 5% return on this bond. What is the market price of this bond? Okay, something I didn't tell you earlier, and that is yield to maturity is an APR. APRs are just the sub-period rate times the number of sub-periods per year. When we were looking at years, or months in a year, there were 12 sub-periods in the year. And if we multiply the sub-period rate, the monthly rate, times 12, we would get our APR. Well, yield to maturity is an APR, and in this case, it means that 6-month rate multiplied by 2 is going to be our yearly rate, which in this case is 5%. And so there are some adjustments that we have to make in order to get this to work. So let's get our calculators out. And the first thing, of course, we want to do is second future value to clear TBM. Face value of 1,000. That's the first thing I always do when I'm doing a bond calculation. It gives me a sense of accomplishment, even though I haven't really done much. Now, the next thing is it's got 6% coupon on 1,000. And so we said that was $60 a year, but how much is my payment going to be this time? Ooh, swing and a miss. 30, because we're taking that 60 and dividing it into 2, right? Okay, so 30 payment. And let's see, it's 10 years to maturity. What should I put in for N?
60.
10 years to maturity?
20, sorry.
Oh, very good. 20 N, because there are 26-month periods, right? Does that make sense? Okay. And then the last thing we have to do is we have to convert that yield to maturity into a 6-month rate. And if I take 5 and divide by 2, I get 2.5 I per Y, and then I'm going to compute present value. Now notice that this one is 1,077.95, so it's still a premium bond, right? And we notice that previously it was 1,077.21, this time it's 0.95. Why is this one worth slightly more? Yeah, because of the compounding. Remember on that other bond, we bought the bond and then we sat around all lonely for a year waiting for our coupon to show up. But with this one, half the annual coupon shows up after 6 months. What can we do with that? Reinvest it, right? And so we get compounding on these that we don't get on the annual bond. Does that make sense? Okay, now, the way to remember, if you can't remember this, basically we're putting everything in 6 months terms. And so you got to cut that annual yield to maturity in half. You've got to cut the annual coupon amount in half. And what do you have to do to the number of years? Yeah, you got to double it. If you have a trouble remembering in the heat of battle, go ahead and write those things on your note sheet. This stuff that I've got on the bottom, N doubles, I per Y, and payment cut in half, because you might just vapor lock during the exam. Okay, so far all we've been doing is calculating bond price, but we know there are other exciting things that we can calculate. In this case, we're going to calculate the yield to maturity. And so what's the first thing we do on our calculator? Always. Second, future value, declare time value of money. Okay, face value 1,000. So remember, you put your 1,000 in and feel like you've done something. And then it's got a coupon rate of 6% and 10 years to maturity. The coupon or the interest is paid semi-annually. How much is the coupon here? 6% times 1,000 is 60, so the coupon is 30 PMT. Now notice those are both positive signs. When I put in the price as the present value, 864.10, what do I need to do with that number? It's got to be a negative because it's cash flow in the other direction. And I per Y, that's what we're going to be calculating. And here, got 10 years to maturity. How many semi-annual periods? 20. And then I'm going to compute I per Y. And it comes out to be 3.9999. Well, anyway, 4%. Is that your yield to maturity? No. Why not? Yeah, it's got to be double that because this is the 6-month rate, and yield to maturity is an APR. We have to take the subperiod rate times the number of subperiods. There are 2 6-month subperiods in the year, so we got to take this number, multiply by 2 to get 8 as our yield to maturity. Questions? By the way, should you go back through all these examples later and make sure that you can make them work? Oh yeah. It's so funny to watch people do something and I always think, oh yeah, that's easy, I could do that. But let's use drywall for an example. I've been doing drywall at my house. And I watch these videos on YouTube and I'm like, oh yeah, that's easy, a monkey could do that. Well, apparently monkeys are smarter than me because I can't make that work, right? You gotta practice or you won't get it. So that's why I'm telling you to go back and rework these. A bond has a coupon rate of 6%. Interest is paid semi-annually. The bond yields 7% and is selling for $973.36. How many years until this bond matures? Can anyone tell me what the face value of this bond is? It's $1,000. How did you know? It's what we always assume unless you hear otherwise. And in fact, so go ahead and second clear TVM. Some of you will be sitting in the exam and you will say, that jerk did not give me enough information to solve this problem. And when you think that, I want you to think, aha, the face value is 1,000. Right? Okay, so here we go, 1,000, future value. 6% coupon, semi-annual, how much is the payment? 30. PMT, present value, 973.36. What do I do next? Negative, and then goes into present value. What is I per Y? Yeah, 3.5. We got to take that 7 divided by 2 equals 3.5. Going to go into I per Y there. And now what are we going to compute? And compute N. And it comes out as 6. Does that mean 6 years? No, why not? Yeah. You got to cut it in half. So what we've got here are 6-month periods. So that's the same as 3 years. Does that make sense? Oh yeah, this doubling and cutting in half can really mess with your head. Okay, so the last thing that we need to do, we've calculated every other single thing, but now we need to calculate the bond's coupon rate. Do we put the coupon rate directly into the calculator? No. So where does the coupon rate for us actually show up? of the things we put in the calculator? Yeah, the payment. And so what we're going to be doing is we're going to be calculating the payment, and then there's going to be one more step after that. We're going to have to divide by 1,000 to come up with our coupon rate as a decimal. We could divide by 10 to come up with it. Oh, assuming it's not semi-annual, right? We got to figure out the annual amount of coupon. Okay, so let's walk through the example. What's the first thing we do to the calculator? Second, clear TVM. 1071.7. What should I do to that number before I hit present value? Negative. And why do I choose to make present value negative and the other stuff positive? Because I am lazy. I only want to type the negative once, not twice. It has 4 years left to maturity. Payments are semi-annual. What do we put in for N? 8. Very good. The bond yields 5%. What do I put in for I, for Y? 2.5. It's just 5 divided by 2. And then we are going to compute the payment. And the payment comes out to be $149.67. Is that what you guys are getting? Okay. $149.67. Now, it is semi-annual. That doesn't look right to me. I don't know why it doesn't look right. Let's try it again. So 1,000 future value. The payment is what we're going to calculate. 1071.70 present value. And 8N 2.5 I for Y compute payment. There we go. I think what I did is I forgot to put in the future value, the face value. Okay, so if you see a bond with a coupon rate of what we were going to have, what, 60% there? Don't believe it. Okay, now, is this the annual amount of coupon paid? No, it's a 6-month amount, so what do I need to do with it? Gotta multiply it by 2. And now I've got basically $70 a year. 70 divided by 10 tells us that this is a 7% coupon bond. If you wanted to do it with decimals, you could divide it by 1,000 and come out with the decimal equivalent of 7%. So that's the most complex bond pricing problem I will have you work, because you saw all the extra steps you had to go through. Because we can't actually calculate the coupon rate, we have to calculate the payment and then back into the coupon rate. Questions? Okay, now let's talk about the zero coupon bond. If you had to guess, what do you think the coupon rate on a zero coupon bond is? 0. And so we take 0 times 1,000, and annual coupon paid is 0. And if it's semi-annual, we divide that by 2, so the semi-annual coupon is 0. And so you're looking at this, you're like, basically, it's just present value and future value. Easy enough. But here's something that we do that's kind of weird. That is, we treat these as if they are semi-annual coupon bonds. You say, wait a minute, what's the difference between getting 0 every 6 months or getting 0 every year? Well, it turns out when you're calculating a rate of return, it does matter for purposes because of compounding. And now, the next question is this: why are we so stupid as to price zero coupon bonds as semi-annual coupons? And the answer is this: bond traders are not complex creatures. Bond traders, what they usually work with are semi-annual coupon bonds that have actual coupons, right? And so they know really well about doubling and cutting in half, all that stuff. And so they decided we're going to price these zero coupon bonds in the same way. Now, be careful to read the question. If I tell you I'll give you a clue if I want you to price it as an annual bond. Otherwise, convention says you got to treat it as a semi-annual bond. Now, after you get out of this joint, if you don't go into bond trading, how important will that be to you? Probably not very important. But for getting correct answers on the exam, should it be important to you?
Yes.
Oh yeah, very good. Thank you, Ms. Lars, for your affirmative answer. Okay, now, here's something fun that we can tell you for sure about premium bonds or discount bonds. Let me start out by talking about, giving an example of a baby. So you're holding a newborn baby in your arms. You look at the baby and you say, this baby could wind up to be president. They could wind up to be an astronaut, or dare we dream, they could wind up to be a finance professor, right? This baby, so many possibilities. Can any of us determine what's going to happen with that baby in its life? No, we don't know where the baby's going to go, what the baby's going to do. We only know one thing for sure about the baby. What's eventually going to happen to the baby? Miss Smith, what's eventually going to happen to the baby? You don't know. It'll grow, well, we don't even know that, do we?
It'll die.
It'll die. Oh, you're just as dark as I am. Yes. Okay, so yeah, the baby's gonna die. Now, if you haven't contemplated your own mortality, this is a service that I provide. Okay, now on with the story. Why do I tell you that horrible story? Because we know that bonds in their life, all bonds in their lives, being worth $1,000. All bonds in their lives being worth $1,000. Let me explain to you why that is. So here we are, we've been collecting our coupons all through the bond's life, and we have collected, there's like 1 second left to live on the bond. We collect our last coupon. What's the bond worth in that split second before it matures? It's exactly 1,000, right? It's exactly worth 1,000. And so that means if you start out as a premium bond, over the life of the bond, you can expect a capital loss as the bond goes down to 1,000. Let me say that again. Over the life, you had to actually get your pencil out. Over the life, there you go. Over the life of a premium bond, we expect a capital loss as the bond's value falls to 1,000. Over the life of a premium bond, we expect a capital loss as the bond's value falls to 1,000. So that's the bad news. What's the good news? Over the life of a discount bond, we expect a capital gain as the price rises to 1,000. Over the life of a discount bond, we expect a capital gain as the bond rises to $1,000. Okay, now this picture, I drew this picture, I created it in Excel, and I used the yield to maturity staying constant over the life of the bond. And you say, wait a minute, what if yield to maturity fluctuates over the life of the bond? And here's what it would look like. It would look very similar, except it just jumps around that line. What do we know for sure? We know the bond's going to end up at 1,000. So it really doesn't matter in the meantime, all the crazy stuff that happens, because it ends up at 1,000. And the same is true of the discount bond. It'll jump up and down a lot, but when we get here, we know exactly where it's going to end up at. Does that make sense? Any questions? Okay, this is something that really trips students up. If I said to you to calculate the current yield, you would think, that's the yield to maturity that the bond is currently exhibiting. It's not. Current yield is its own thing. Current yield is actually easier to calculate than yield to maturity. Current yield is just the annual amount of coupon divided by the bond's price. It's the annual amount of coupon divided by the bond's price. Should this formula be on your note sheet? Yeah. So if you're reading along and the question asks you for the current yield, it's asking for this thing. If you're reading along and it asks you for the current yield to maturity, it's asking for the other thing. So remember, in finance, before math, we always have to read. Okay. Now, for discount bonds, the current yield is going to be lower than the yield to maturity. And the reason is because it ignores that capital gain. Remember, for discount bonds, the coupons are smaller than the yield to maturity, than is necessary to meet the demand. And so those are going to be, that annual coupon number on the top is going to be smaller. And for the premium bonds, that current yield is going to be higher than yield to maturity because the coupons are more than enough to meet investors' demanded return. And so this current yield is always related to those things. And in fact, if we had a par bond, what do you think the relationship would be? Yeah, current yield would equal coupon rate would equal yield to maturity. They would all be the same. Questions? Yeah.
And you said that yield to maturity equals APR?
Yeah, so yield to maturity is an APR, which means all APR means is the subperiods per year multiplied by the subperiod per rate. Number of subperiods per year multiplied by the subperiod rate. In this case, for semi-annual bonds, there are 2 subperiods per year, and we're going to multiply that by the half-year rate or 6-month rate, and that's going to give us our yield to maturity, which is expressed as an APR.
Okay, and we won't have to do that for current yield, would we?
No.
Okay.
No. In fact, if you'll notice, it says it's the annual coupon divided by bond price. So current yield is agnostic, means it doesn't care whether your coupons are annual or semi-annual. Really doesn't care. So we talked about interest rate risk or price risk a little bit in chapter 10, and we said that's the risk that the price of your investment or your loan to someone is going to change based on the interest rate changing. And we said that basically the value of stuff is the present value equal future value divided by 1 plus r to the t. And so we know as this r changes, we know that present value changes. If interest rates go up, present value goes down. Now that's for each of the individual coupons and the final face value. If you add all those together, if interest rates go up, bond prices go down. So here is another truth of bonds, and I will demonstrate it to you with an interpretive dance. Are you ready? As interest rates go down, yield to maturity goes down, bond prices go up. As yield to maturity goes up, interest rates go up, bond prices go down. They always move mathematically, mechanically opposite of each other. I love reading the Wall Street Journal because they write it for a whole spectrum, right? From people who don't know anything to people who know everything, or think they do. And they always, in bond stories, they always say, bond yields move in the opposite direction of their prices. Well, if you have even the most basic understanding of bonds, you already know that, right? But it's nice that they say it just to remind us. Okay, now let's think about what's going to make this thing more sensitive to interest rate changes. Number one, the longer time to maturity, the worse this problem is. Remember when we were talking about the 3-month treasury yield, we said this t was 0.25. And so the smallest little change would be magnified to the 0.25 power, which is like taking the square root of the square root. So we're talking about tiny. But what about if it's a 10-year bond? Now, this change in R is getting multiplied or getting magnified to the 10th power. What if it's a 30-year bond? Now we're up to the 30th power. So it magnifies based on the length of time between now and when the bond matures. And by the way, let's just think, we can think of this as the face value of the bond, but it's happening with the coupons too, right? So the 30-year bond has 20 years worth of coupons out beyond the coupons of the 10-year bond, and those coupons have T's that are greater than 10, right? And so we can see the same problem with the coupons as well as the face value. Now, oh, by the way, have I told you ceteris paribus? What does ceteris paribus mean? Have I told it to you before? It's Latin.
It's the same.
Yeah, all else equal. Our Latin scholars come through for us. Ceteris paribus means all else equal. And so, we're talking about is if you just change time, that's what's going to happen. If you leave everything else the same, you just change time, that's what's going to happen. Now, if you only change the size of the coupons, then we're also we can be more sensitive to the changes. So, for example, bonds with smaller coupons are more sensitive. Let's think of the absolute smallest coupon you could get. What would it be? 0, very good. So a 0 coupon bond has every bit of its value hanging out here at the very end with the face value or par value. Does that make sense? And so every bit of that bond's value is hanging out here to the 30th power if it's a 30-year 0 coupon bond. By the way, I wouldn't buy a 30-year 0 coupon bond because who knows if they're going to be around 30 years, right? Maybe that's just me. Okay, back to the story. So, what if, though, the bond has coupons? Well, now, not 100% of that present value is based on that face value. Now, some of that value is based on the coupons. And when do we get the coupons? Well, we get the first one at 6 months. That's to the 0.5 power. We get the second one in 1 year, and that's to the first power. We get the third one at time 1.5, and so forth. And so you've got more of a percentage. The bigger your coupons get, the greater the percentage of the bond's value is represented by those coupons, and those coupons are not as sensitive to the changes in interest rates because they're not the greater value of that bond you're getting sooner in time, right? And so if you just need to remember it, here's the problem, the greater sensitivity. Longer time to maturity, skinnier coupons. Longer time to maturity, skinnier coupons makes bonds more susceptible to interest rate risk. Longer times to maturity and skinnier coupons. And of course, the skinniest coupons of all are 0. Here we have an example for you visual learners. We've got 2 bonds here that have the identical coupon rate. Remember, we said that when the yield to maturity is equal to the coupon rate, the bond sells for what? If the yield to maturity is equal to the coupon rate, the bond sells for face value, which is 1,000. Okay, so take a look up here. Both these bonds at 1,000 are worth 1,000 at 10%. And by the way, that bottom, scratch out interest rate and right yield to maturity. Scratch out interest rate and right yield to maturity. Okay, now let's see what happens. So we're sitting here and I've got the 30-year bond and you've got the 1-year bond. And interest rates drop down to 5%, or the yield to maturity drops to 5%. Your bond increases to $1,047.62. So you're basically up 4.76%. And you call me up and you're like, hey, Dr. Haggard, my bond is up 5%. I say, that's great. My bond's up 76.862%. Do you see that? That same drop in interest rate that boosted the 1-year bond only 5% boosted my 30-year bond 76.862. And I laugh and I laugh and I laugh because I've got so much money and you don't. Now, interest rates then start to go up. And then before long, yield to maturity is up to 20 years. And you call me and you say, oh, Dr. Haggard, I'm so distraught. my bond is down 8.3%. And I say, phew, mine's down 49.8%. And then you laugh and you laugh and you laugh and you make fun of me. Because that's what friends do, right? Okay, do you see what's going on here? The interest rate risk is great for you when interest rates are falling. They're lousy for you when interest rates are rising. So I was called, they asked me, every once in a while I get asked to go out and speak to members of the community, and I was asked to go speak to the 12 most valuable customers of a trust company here in town, which I won't name. So who do you think the 12 most valuable customers of a trust company are? By the way, trust companies manage money for people. Yeah, rich folks. And so these are the 12 richest people that the trust company looks out for their money. Okay. Now I'm sitting around the table, and it's like me and all these old white dudes. That's the 12 richest guys that well, anyway. So we're sitting there, we're eating some rubbery chicken, and then I get up to give my talk. And I'd actually heard him talking over lunch about how they've been buying 30-year treasury bonds. And I said, okay, and at the time, the yield on the treasury, 30-year treasury, was 3.875, and that's what they were issuing them with, 3.875% annual coupon. I said, how many of you have recently bought a 30-year treasury bond? And of course, almost all of them, because old guys love bonds, right? Especially U.S. government bonds. I said, how many? And it's almost every hand. I said, okay, here's what you need to know. Interest rates are mean reverting, which means they return to their historical average level. There are very few things we know for sure in finance, but that's one of them. Interest rates are mean reverting, which means they return to their historical average over time. Oh, by the way, you know what the historical average yield maturity for a 30-year coupon bond is? And someone says, yeah, about 7%. I said, you're right. I'd actually gone out and collected it, but he was pretty close. I said, okay, now, what do you think would happen to that value of the newly purchased 30-year treasury bond that you just bought if interest rates return to their historical levels? And then I popped up the picture, 43% drop in value. And it's like all the color just whew, from these guys' faces. I thought they were going to have to call an ambulance. Do you think they've asked me to come back to speak to that group again? No. Okay. So, interest rate risk is real. It can really mess you up. So here's an example of interest rate risk in the real world. By the way, this is a bond that General Motors issued back in 1995. It had a 100-year time to maturity. Now, in the whole world of interest rate risk, if it's got a 100-year time to maturity, is this bond not sensitive to interest rate risk or very sensitive to interest rate risk? It's very sensitive. Remember we said the longer the time, the worse it was. And originally, the coupon rate was 7%. And when it sold on December 31st, 1995, it sold for face value. What does that mean? The yield to maturity had to be on that day. 7%, very good. Okay, now, interest rates then went up. The price on July 31st, 1996 was $800. So the interest rate went up, therefore the bond price went down. And I remember this. We were buying our first house about this time, and the interest rate was, we got a loan for 8%, and we were glad to get it. We thought that was amazingly good. My interest rate right now is 3.375 for comparison. Okay, so that's a 20% drop, purely because of this increase in the yield, increase in the yield to maturity. Now, the bond price on September 26, 2007 was actually $1,020. What can we say about the yield to maturity on that day? Was it greater or less than the coupon rate? We just talked about this earlier. The coupons, if the coupons are more than enough to satisfy the return, then people are willing to pay a premium. Therefore, we know the yield to maturity had to actually be lower than 7% on that day. That's a 27.5% increase. And so the interest rate risk hurt these people as the interest rate was going up. and it helps them as the interest rate's going down. But my question to you is, what do you think this bond's worth today? Just take a guess. Zero. Why? What happened to General Motors in, say, 2008, 2009-ish? Yeah, they went bankrupt. These old guys sitting around the table at the trust company, they had bonds in GM. They trusted GM like they trusted Uncle Sam and Mom and Apple Pie, and they put their money with GM, even though GM probably wasn't in the best shape when they did that. But they remembered GM being a big thing, right? And they got totally taken to the cleaners on this whole deal. Questions? Okay, well, I'm going to leave you on that optimistic note for today. And when we come back, let's see, today's Thursday, so when I see you on Tuesday, we'll finish chapter 5 and we'll get into chapter 6. Okay, so last time we talked about something called interest rate risk. And we said there were two things about bonds that make interest rate risk greater. Does anyone recall what they were? So there's a real simple one. What's the first one?
Bond prices go down.
Say again?
Bond prices go down.
Okay, that's what interest rate risk is. But what are the two characteristics of bonds that make this worse? You look like you had the answer. Yeah.
Short time maturity and longer coupons.
Okay, so it's actually, so you're looking at this one.
Yeah, my bad, sorry.
Yeah, he's just trying to fake it. Yeah. So, what's that? Fake it till you make it? Yeah. Yeah, ask what's Elizabeth Holmes at Theranos how well that works, right? Yeah. It's fun while it lasted. Now she's going to the pokey. Back to the story. Okay, so you had it exactly the opposite of what it should be. Long time to maturity and skinny coupons gives us high interest rate risk. And the reason I point that out is because it's going to be exactly the opposite of this new thing we're going to talk about, and that is reinvestment risk. And reinvestment risk comes about as having to reinvest these cash flows as you get them. And so if you have a long-term zero coupon bond, the reinvestment risk is low because let's say it's 30 years. It's 30 years before you receive a penny that you have to reinvest. So your reinvestment risk is really low. On the other hand, your interest rate risk is extraordinarily high. Now, what about coupons? Well, we said that to get away from interest rate risk, we would like fat coupons. But here, fat coupons gives you greater risk because every 6 months I'm getting this big fat coupon, and what do I have to do with it? Some of you will say spend it on strippers and blow, but that's not right. Reinvest, you gotta reinvest it, right? And so every 6 months I'm getting this big fat coupon and I've got to reinvest it. And so the two things that make bonds safer from an interest rate risk perspective make them riskier from a reinvestment risk perspective, and the things that make things safer for reinvestment risk make it riskier for interest rate risk. Do you see how that works? So what does this mean? It means you can't get away from risk. You're trading one off versus the other. You're trading one off versus the other. And so you've got to look at your own time horizon and figure out which one is more important to you.